This is Ken Boyd, St. Louis Test Preparation, and this is the second part of our series, Understanding the Insurance Statement. Here's our email address and our phone number. You'll also see a great website, Investopedia.com, where we got the information for this presentation. As you saw in the first presentation, we wanted you to imagine having your own insurance statement and getting it in the mail. And I flipped to Excel, where we see three kinds of insurance: term life, whole life, and universal life. If I flip back to PowerPoint, I have these three definitions we talked about earlier. Term life is like car insurance. You're simply paying for coverage. You get no other benefit or value other than the fact that you're covered. If it's your car insurance, you're insured on your car. If it's life insurance, your life is insured for a fixed period of time. Whole life, on the other hand, is lifetime protection with a predetermined premium. And in this case, you'll build something called cash value. You'll have some value in your policy over and above the cost of the insurance. The one that I didn't get to was universal life, and I included here in parentheses variable universal life, which has become more popular. There's a investment feature, and there's also a death benefit, and the two are separated, and this is what I'd like to spend time on. Flipping back to Excel here, we look at universal life at the bottom of the page. There's a $230,000 face amount, which, like the other policies, is the death benefit you get should you pass away. The insured is Bob Johnson. That's whose life we're insuring. The beneficiary is his wife, Cindy. But here's what's different. In this case, we are sending dollars into something akin to a mutual fund. I called it the Blue Chip Stock Fund. So some of our insurance premiums are going into an investment vehicle. Let's say that the current value is $60,000. So we invested amounts over and above the cost of the insurance, and those have accumulated with our investments and the growth of the fund into an account that's now worth $60,000. There are several things you can do with that amount of money. One of the things you can do is withdraw it as a loan. So to have an example here, our made-up insurance statement says we have a loan balance of $10,000. So that if we take the $60,000 market value, we subtract the $10,000 loan balance, pardon me, we come up with a cash value of $50,000, and I put in parentheses investment value less loan balance. You'll see that the monthly premiums are much higher than my other examples, $650. Scrolling back up here, the term life was $50 a month. The whole life, just life insurance coverage, was $375. There are a few risks here that I'd like you to know, though, on this universal life. You have to be very careful to understand if there's a floor, a minimum value at which your account will stand. For example, if you invested in this blue chip stock fund and the markets went down sharply, is it possible for the value to go below the amount of money that you originally put in? Is there a guaranteed floor? Is there a guaranteed minimum rate of return that you're offered? And another thing to understand is, if you're going to borrow money on the policy, what's the repayment rate? What interest rate will you be charged? You will be charged an interest rate. It is a loan. And what are the terms of paying the money back? One last consideration is that if you were to borrow a large amount of this value and the stock fund's market value went down, you could get to a point where you were forced to pay back the loan because the market value that's securing the loan essentially would be below your loan balance, and you may have to pay back the loan more quickly than you wanted. So while this is a great vehicle and has a lot of benefits, it's also very complicated. The prospectus you'll be asked to read is very lengthy, and you just need to be aware that there's a lot of moving pieces and there can be a lot of risk to the client. So I'm hoping that you've benefited from seeing an example of an insurance policy with three different types of insurance, and now understand the the differences between the three. I'm going to go back to my PowerPoint here. and go to my universal life here at the end. Just to sum up, the death benefit and the investments are separated, as I mentioned. There's an equity or stock investment component, which is going to increase your cash value faster, hopefully, than if you were just earning a fixed rate of interest. Hopefully the stocks in the portfolio, dividends and gains would grow faster than if you just invested in a whole life product with a fixed rate of return on your cash value. The premium payments are flexible and the death benefit's flexible, which I didn't mention before. If the value of your policy is high enough, you may be able to scale back your premium payments and have the same amount of death benefit. On the other hand, it may be possible to reduce the face amount of your death benefit. That may be possible too. So a very complicated product, lots of benefits, but also a fair amount of risk. That's the end of part 2 on our insurance statement. You can find all of our videos at our YouTube channel, Ken Boyd STL, all one word. We have a complete list of all of our videos on the homepage of our website, which is the next bullet point, stltest.net. Another thing you'll find on our website is live tutoring and chat sessions that go on continually. Here's our email address and our phone number. Thanks very much, and we'll see you next time.